And here are your options for the FERS employee. You have 3 options. CSRs have multiple more options, but it's the same kind of principle, if you will. Number 1, you can elect a 50% annuity for your spouse. So if you pass away, they get 50%. In so doing, the cost is 10% a year of that pension. I'll illustrate that in just a moment. Your second option is 25% survivor's annuity for your spouse. That cost is 5% of your pension every year. Or you can leave them nothing and you pay nothing. Yes, that's right, nothing for nothing. As a FERS employee, if you want your spouse to continue the health insurance at your passing, then typically option 3 is not a valid option. You have to leave them as a beneficiary on the annuity. So they're on the annuitant rolls to be able to receive the health insurance through their retirement if you passed away first. So a couple of other rules around the health insurance. That's beyond the scope of what I'm trying to give you today. But I want to give you reasons why this happens. And to break this out, we're going to assume a 50% survivor annuity is given. And let's walk through an example here. Let's take your annuity. Let's say it's $36,000 a year. You want a 10% reduction, right? $3,600 is going to come off the annuity, leaving you with $32,400. If you pass away, your spouse gets $18,000 a year. Fast forward 25 years. Now, because of COLA's at 2%, now this isn't a promise of 2%. This is about what it's been over time. Then your annuity would be $57,000. 10% of that number now is $5,700. So that's what you're paying. You're losing in benefit. So you got a $52,000 pension. And if you pass away 25 years later, then there's $28,000 for your spouse for the rest of their life. Now, again, you're 25 years older. They are too, right? So maybe there's not as much time for them to live, but that works. So over this time frame, how much have you paid in your survivor's benefit? Yes, you have paid $115,000 paid to date for that 25 years. Now, if your spouse dies first, what happens to the $115,000 that you've paid into the system? You guessed it. That's right. It's gone. Poof. It vanishes. It does not come back to you. It does not go anywhere. The government keeps that and puts that in the risk pool for someone else. Now you do get a step up if they pass away first, and you were drawing $32,000 in this example above. You see here, then you would take the $36,000. So there'd be an increase in the survivor's annuity. So when you, as I said a moment ago, you die, someone else gets a benefit. What do we call that? That's life insurance. So as you're making these decisions on what deductions are going to come from your pension, as we get to your bring home pay, remember our goal is to figure out what you're actually going to bring home and live on in retirement. Then we need to figure out how to maximize that bring home pay. So you need to do a comparison of the survivor benefit, as you see on the right hand side of the screen, and life insurance on the left hand side of the screen. We would also nod our head toward, if you've collected enough money, you have enough assets to where you're self-insured, then you may need neither of these kind of programs. But let's walk through the pros and cons of your 2 choices that you have to be a wise consumer of the insurance benefit coming in front of you. Number 1, your payment options. Life insurance can pay out as a lump sum or as a monthly income stream. The survivor benefit is always an income stream. You have life insurance policies, you have flexibility, you have control of what you do with the death benefit and all the elements of a policy. Survivor benefit is you pay, you die, someone else gets a check. You can change your beneficiaries on life insurance. A survivor's benefit, if it's not left to your spouse, it can be left to children or what have you, but the cost, instead of being 10%, can quickly get to 40% of your pension. So it can be a very expensive venture. Again, if you look at the cost, that would make it not a good deal for most survivor benefit elections. Insurable interest, life insurance and survivor benefit both have that. That's exactly what you see the 40% number on the screen. That's what I was referring to, in that the younger someone is that is a beneficiary, the more it costs you. In life insurance, as long as someone has some kind of insurable interest, you can get that policy for whatever your health classification will buy on it, which is the cost of life insurance, right? It's based on your age and your health. It's not, you don't buy it with your money, you buy it with your health. Survivor's benefit is a standardized cost based on just what your pension's worth and 10% of that number. Death benefits are tax-free with life insurance. There may be some tax implications to the survivor's benefit. Depending on the life insurance that you buy, you may or may not get that inflation protection, whereas a survivor benefit does get to participate in the annual COLAs that Congress allows for that group of people, for FERS or for CSRS, based on the formulas that they have in place. Take note, what I already mentioned one time, if you leave no survivor benefit, then your surviving spouse cannot take FEHB. That is not an option for them. But if you have some survivor benefit, even if it's just the 25% option for FERS or even 1% for CSRS, then in that case, you must choose a minimum survivor annuity to get that benefit in their hands. So let me pause. We're going to let Erica take over just a moment, just in case on what I just covered. Lindsay has any great questions. She's over there typing away, answering your questions as fast as you can. Anything you want to shoot out, Lindsay, or you're doing fine over there? Either way.
Are the survivor benefit versus life insurance issues same for CSRS?
Yeah, for CSRS, thank you. I know it's hard to talk both languages continuously in the program. So the question is, are the survivor benefit choices the same for CSRS? Actually, CSRS, you get a lot of options, meaning you can choose to leave your spouse 55%, 54%, 53%, on down to 1% of your pension.